All right, welcome to this month's education training from Blueprint. Just in case if you're not a client of Blueprint already, we built Income Expert. It's an online income calculation software. We've been in business a little over 11 years, have a couple hundred different banks using us every month, and we process a little over 30,000 some loans per month. So we have a lot of experience reviewing income. Now, these free webinars, the reason we put these on is part of using a calculator. We just want to make sure you have some basic understanding of the kind of the what behind the why, like what information is needed with the calculators. That way you can get the best quality results of your income review. So we do these for free. I've been training underwriters for 25 plus years. I've been an underwriter myself since about 1997. I've been in the mortgage business since 1994. All right, so enough promotion. This is a educational webinar, not here to sell you anything. But if you're not familiar with Blueprint, an income expert, at the end, we'll give you an email address that you can email and ask questions from a sales standpoint. But this whole webinar is going to be educational. We're not here to sell you anything. We're just here to show you some information. All right, let's talk about seasonal income. So we're going to talk about what it is, how to calculate it, what the history requirements, and how do you document that type of income. Now, whenever you start off with income reviews, there's 4 key requirements that all incomes have. And I just call it the 4 requirements of all income. So no matter what kind of income you're talking about, the number one thing is it has to reasonably continue for 36 months. Now, nobody can guarantee it continues, but you shouldn't be aware of any reason it's going to stop. Like the borrower told you they're going to quit a job, in a couple weeks, or like in seasonal income, it's maybe February and they work at like a summer resort and they told you they're not going back. Well, that would make it not qualify because now you have reasonability that it's not going to continue for 36 months or going forward. The second thing is income's got to be stable. We have to be able to check the income and make sure it's got a stable amount. And the way the agencies describe the income you should use all the time is the income that's most likely to continue. If a borrower makes 8 grand one month and 2 grand the next month, you want to find the number that would most likely continue. Probably not 8, but I'm sure it's higher than 2. Then you got to have the right history requirements, and each type of income has a different history requirement. And then you got to have the right documentation. So starting off with that premise, those are the things you have to know before you even get into any specific type of income like seasonal. All right, next thing. What is seasonal income? How is it described? How do I know I've got seasonal income for a borrower? Now, all it means is employment does not happen year round. There's no specific industry or other thing besides just, hey, there's no way they, generally speaking, there's no way they work it all year round. Like people think of ski resorts or summer beach thing, but actually there's a lot of different type of seasonal incomes. They are white collar and blue collar. For example, travel or resort workers, if they work on like a cruise ship, they may work 4 or 5 months a year and then go back. Now, I live in Michigan, and there's a really nice vacation area up in a little bit north of where we're at, a couple hours, called Mackinac Island. Beautiful island, lots of fun. It's historic. They don't allow cars on it, so there's horse-drawn cars and stuff like that. But you'll find that the people that work there, there's a lot of immigrants, but there's also people from different states, and they're only open like 6 to 8 months to a year. It's not much fun to walk around that island that's sitting in a big lake in December when the lake is frozen and it's really cold out. So it's a very temporary thing. But there's accountants there, there's people that work the restaurants. So it's that type of thing, right? They're not going to be there all year. Landscape workers, retail, commercial fishermen, would fit. Again, the key is that they work the job and part of the year they can't because of the weather or there's just no business or there's no tourist or whatever it is. Okay, so let's kind of picture what that looks like. Think about the salary or income they're earning is blue and the unemployment is orange. So during the year, like in a ski resort here in Michigan, I kind of use that example. As it gets colder from September to October and starts snowing in November, December, it's going to get busier and busier because it's going to have snow on the ground and they can start skiing. And then once you get through the winter and it warms back up, it's going to drop off because there's no more snow. You can't, ski on the mud hills. And then the orange means that your unemployment is kicking in. The only time you can use unemployment in the mortgage world is when it's used alongside of seasonal income. If somebody lost their job and they've been on unemployment for a couple months, it's not going to continue for 36 months, so it would never qualify. This kind of unemployment, though, is every year you get it, and it covers you for the few months during the summer. Every state's a little different how long it lasts. I don't really know each one. I've never been on unemployment. I think Michigan is something like 16 weeks or maybe it's a little bit longer, but it's not a long time. You can't qualify for a mortgage on it. It just helps you get through a rough patch in your life. So this is what it would look like. You got pay and you got unemployment, which is all part of your income to qualify for the mortgage. Now we're going to go through what do the guidelines say about calculating seasonal income. Well, when you first read like Fannie and Freddie, unlike FHA, they don't really specify how you do the math. They just say, hey, seasonal income, make sure you have a 2-year history. You can also add the unemployment compensation as long as you see it. Same thing for Freddie down here. They're a little better about, most likely continue for 3 years. And then they kind of add in the unemployment compensation with it associated with seasonal unemployment. But they don't really work out the math, what you're supposed to do, how you're supposed to average it. So you have to go back to that original 4 requirements, stable to qualify. How do I prove stability? Well, when you think about people that work seasonal income, typically speaking, they're not working 40 hours a week, 52 weeks a year. They're working 40 or 60 hours a week in the busy season. It drops off. They may work 10, 20 hours a week, and then it just drops off to nothing. That's more variable. Variable income means you don't have a set hourly rate, or you don't have a set of hours, or both, right? So this is not somebody that works a solid 40 hours a week, 52 weeks a year. So therefore, they're variable. So when you look up in the conforming guidelines, this is Fannie Mae. All income is calculated by averaging method. Well, variable income or seasonal income would qualify that way. Now, what math do you do to show stability? Well, according to the income trending analysis, which is a paragraph or 2 down from the description of variable income, you basically take the year to date, the last year's income, which in this case would be 25's year to date. You would have 24 for last year and 23 for the year before. And you look at them all and see what their trend analysis is. If it's stable or increasing, you average it. If it's declining but stabilized, you would then average the stabilized income. At no point can you put the good year in there, though. You got to have, the high year, right? If it went down, you could take last year and this year it stabilized, but you can't add in the really good year from 2023. And if it's declining, it's 23, then 22 or 24 goes down, and then 25 is even going lower, you're not supposed to use it. But if you have good enough explanation and you believe where it's at right now, its lowest point will hold, you can use it. You can never mix in the previous years, though, because it says right at the end. But in no instance may it be averaged over the period when declination occurred. So you can't, if you had, $4,000 a month in 24, and now you're averaging 2, you cannot use 24 anymore. You can only use the $2,000 a month in 25. You can be really careful about using declining income. So that's the basics from Fannie. Freddie has basically the same thing, just a couple examples of their wording. It's worded different, but the method is still the same. Now, let's put like a common example to show you a live example what I mean by this. So you have a borrower and they are a seasonal worker, and we're using 25, 24, 23 in this sample today. So they give you the pay stubs. As of so far, they've made 21 grand in the middle of the year. Just to say it's 6/30 of 2025. Last year they made 37, the year before 34. So you can see we have stable or increasing income. Because you figure if you're halfway through the year, if you double that, it's about 42. So you kind of estimate it's going up 34, 37, 42. Well, you add that up, it's 92 grand. And what you want to do, remember, stable or increasing, you want to average them all out. So you put them all together, divide by 30 months, and then you get a total of 3066.67 per month. That's the way the guidelines say to do it. The next thing is I've got my 306667, and I want to get my unemployment. Now I put a very specific example because this is the one that creates the most questions. So I've got my monthly income from the job itself, but I can add on the unemployment. But unemployment, they just start getting in the summer. The summer months the only time they get it in our example. But they haven't gotten any yet. So what do? Well, here's how I recommend you do it. This is the safe way. I would call this a best practice. I can't show you the guidelines, but after 30 years of being in the business and a lot of underwriting and a lot of mortgage calculations running this company, I can tell you what I've seen from my experience, which is, look, you made 7,400 of unemployment in 23, then 6,400. It's fine. You believe they're going to get it again. And it's not like the government, is going to give you these crazy amounts. They're generally pretty consistent for all citizens. I would add up that 30 months of it. I know there's 6 months of zero in there, but it's the more conservative number. And you're following the exact same math you did with the actual job, which would be taking those numbers divided by 30 is 460. Now, some underwriters will argue, well, I'll just take the last 2 years because they haven't gotten any this year, but I know they're going to get it. Well, my question is, you know they're going to get it, so tell me exactly at the end of 2025 what they're going to earn. You can't tell, right? Because you don't know when they're going to file it. Maybe they come back in the summer. Maybe they, decide they don't want to claim it and start looking for another job, and they work at Starbucks or something during the summer. You're guessing. Like underwriting, you can make guesses. It's not a best practice, right? So we don't want to be guessing when we don't have to. If the deal will work with 460 a month in unemployment and 3066 in income, let it ride like that. Don't push the envelope when you don't have to. So now that's how that all works out for a conforming borrower. But FHA, and I'll put the governments in one batch too. You got Fannie, Freddie in one batch, and you got FHA, VA, USDA in another batch. The good thing about FHA is when they tell you to calculate it, they're better at like telling you in the calculation, lender must average income over the previous 2 years. So they do take the approach of, we don't care really what you made this year as long as we can see you're making it, it's in line with you've been making last year on average. You're going to use the 2 full years from last year because you're going to be guessing anything that happens the rest of the year now. I like that approach as an underwriter. I actually wish conforming would take that approach, but they won't. FHA's done that for a while. So that's a great approach. I'll show you how that math works out. It's a little bit different than conforming. Now, VA, kind of vague, right? So what I do, I call it the walks like a duck, talks like a duck method. If VA, is it more like a Fannie Freddie loan or is it more like an FHA loan? Well, VA is a government-backed loan, so it's more like FHA. It uses a more conservative rule set than the conforming rules do because they have more manual underwrites and things like that. So I'm going to follow the FHA rules for that. I'm going to use the same method. VA is kind of like just make a good determination. FHA is a good determination, right? It's a good solid number. Can't fault you if you want to follow conforming, but I kind of like to lump the governments together because they're much more similar than VA or FHA is to Fannie or Freddie, right? Conforming is just not the same in the way they think about things. Now, USDA better, they have a 12-month requirement, 2-year history, last 12 months on here. All right, but let me show you what FHA does a bit different. So same exact example. The difference is you're going to focus on these previous 2 years. All this is saying this year is that you have it and it's consistent. Like, I'm making halfway through the year, roughly, $1,800 a month. And, you can tell by these, it's probably in the same range, right? They're going to keep getting it. They're working the same job. So what the FHA wants you to do is add those 2 years up and divide by 24, right? Don't do the 30-month thing like conforming does, which is $29.58.33 per month. Now I take the $29.58.33, I apply the same tactic to the unemployment because that's the way they do it. So that's a 13,800 divided by 24. As you recall, with the conforming, I would have added that 6 months of zero time in there, which lowered it down to like 460. But in this case, you get 575. A little worse on the top income, a little better on the unemployment income. So it just depends what works out for you there. Now, the history again requirement, 2 years says the borrower has verify, what's the right word here, verify, that the borrower has at least a 2-year history of seasonal unemployment and 2 years consecutive, right? It says, when you have less than 2 years, but no less than 1 year, it may be acceptable. So there is kind of an exception between 1 and 2 years. As an underwriter, people ask me, well, when would I do it? I wouldn't do it on a borrower with a 44.9 ratio with no money in the bank for reserves and a 620 FICO score. I would want some other compensating factor. They have a lot of money in the bank. They're putting down a large down payment. They're getting a new job or it just doesn't qualify. You got to be really careful when you give these exceptions. When you give the exception, there's supposed to be something else that leans you toward away from the guidelines, not just, I want the commission. And I'm not knocking loan officers on this. I'm just saying that sometimes loan officers, they advocate for the borrower, which is good, but they lean a little bit too much more like, well, I think the best thing for this borrower is to close this deal, when in reality, they're going to struggle with this payment, right? If we're pushing their income that hard, they have no reserves and anything goes wrong or they have a bad season or it doesn't snow 1 year and like Michigan, right? Snows a lot like this last year, may not snow next year, no overtime. You're just putting people in a bad way when you put them under like large financial burdens that they can barely afford. So we want to kind of avoid that. The government loans, 2 years, 2 years, 2 years. And again, there's rules about exceptions for a little bit less using the same techniques I just said. All right, last thing, I want to show you Income Expert, how it's in there. So I just showed you how to do it by hand, but if you're not an Income Expert client, I want to just show you our software real quick, a little quick sales thing on it. If you are a user, you're going to see this, you're going to recognize all this information, right? But before we go there, you really want to get a VOE, VOI for these, right? Or year-end pay stubs. You can use the W-2, but you're kind of guessing. It's kind of a sloppy method, because when I get a W-2 for 2024, I don't really know what the breakout is in there. It could be some overtime, there might be a bonus. You're kind of guessing. If you're really going to use that, I would really kind of recommend that uh, you get the better documentation, which is the VOE, VOI, or year-end pay stubs mimic a VOE, VOI. Just a best practice, right? Your unemployment compensation is generally going to be a 1099. Now, how do you get year-to-date unemployment? It is hard, but if the person got like 6 checks, like they got one a week for 6 weeks, you could ask them for each check stub and just add it up. I don't think I've ever seen an unemployment where it's like a pay stub where it keeps showing year to date. I could be wrong. There's a lot of them out there, depending on what county you live in and state. Just letting you know what you would see. All right, let me pause here for just a second on the screen, and I'm going to flip up Income Expert and show you how the software does all this stuff pretty easily. All right, so I've logged into my Income Expert account. I'm going to go up to where it says Create Loan, and I'm going to go ahead and create this file. Now, again, these webinars are mainly for our current clients, but if you're not an Income Expert client, just so you know, our calculator allows you to type things into it or upload all the documents and we'll do the work for you, right? There's different price points for each. Just let you know we have both ways. I'm just going to show you a type-in version because the result will be the same as you uploading things to us, and the upload takes a few minutes and can't really do it on this webinar live. All right, so we got our borrower, and I like to pick on Mike Rowe from Dirty Jobs, so I'm putting Mike Rowe in there and say he is working a seasonal job at Boyne Mountain Ski Resort. So employed at Boyne Mountain. That's up in the a little bit higher up in Michigan where I'm at. It's a cold, snowy area. We were there for Christmas. It's a really nice place. The next thing I'm going to do is click on some unemployment. So I want to go down to unemployment, and we'll call it seasonal. All right. Now I got my 2 calculators there. And I'm going to go to my second tab, and we're going to go ahead and put all that information in there that we had in the slide. So I'm going to go ahead and use the VOE, VOI method. And we'll just say that, like I said, right now this is April. I can't put the June in there. But we'll say that the person, again, added about 34 grand in base pay in 2023. Variable base pay, by the way. So I go up here and I say it is variable. So now I got my variable calculations ready to go. They made 37,000 in 24. And so far this year, I'll just put them at 21,000 for the year. Save calculate. And actually, it's a little bit heavy. They probably didn't earn that much yet. My slides have a little bit more in the future than the calculator will allow me to go. So I'm just going to put this a little bit more reasonable number. Okay, so you can see that we went from 2,800 a month, about 3 grand, up to 4,400. Obviously a big jump. This is where FHA is better because, well, is it because you make most of your money in the earlier than the year and don't make as much at the end? Are you going to actually make 4 grand a month all year? Probably not. But that's why they do it that method. But this method is going to check the averaging, and you can see that our system says you made $31.55.60 per month, and it's got a large increase at the end that you're going to need to document. Again, recent large increase. You want to make sure that's stable or explain it on there. So I've got my income done there, and now I'm ready to do my unemployment. So I look at I think let's say about 5 grand came in 23, and then say 5,500 in 24. I don't have anything yet, and remember this is April 17th in this recording. I hit save calculate. Now you're going to notice our calculator is saying, well, I don't really have a number for you yet because you have to give me something this year to verify it's ongoing. This is where it gets a little tricky, right? If you don't have those checks yet, well, you're kind of doing a bit of a guess, right? So what I would definitely recommend you do is, just put $1 in here. And what's going to happen is going to kind of average things together. It's going to show a massive decrease, but it's going to give you that proper average about, $375 per month. Now, you can say, how do you get around that? Well, this is where, again, best practice versus guidelines. You really should have a number in there to understand what it is. So if I knew they'd gotten, $3,000 of it so far, it would be $482 per month. So this calculator requires a little bit of work and thinking. So it's great for underwriters, but you've got to kind of make sure that, you're going to get this kind of number for the year. Just depends what time of year it is, right? That's going to change it. But what you can do is, take a look and say, hey, the 2-year average, even without anything, is 375 per month. I'm going to use that one. Just make a note. I'm going to use 375 per month. Now with our system, I'm getting a little feature for you. You can see that we rep and warrant to 0 because we don't have any current income. But if you go adjust selected income, hit save, and you go ahead and pick that lower of 2, the 25-24 average, 343 per month, you can override it and it'll add it into the calculations of 34.99. All right, so there's your, how you do it in Income Expert. When you're done, you go to report and you're going to go ahead, look at your report. All the data is in here and you're going to hit create PDF and submit that to your underwriting team. Well, that wraps up a presentation about seasonal income and a little bit about Income Expert. If you have any questions about this presentation, you can email us at info@getblueprint.io. Again, my name is Mike. I'm with Blueprint. Thanks for joining today's webinar. And we have hosted one of these webinars once a month on the third Thursday of every month. And if you're interested in the previous webinars we've done, or to make sure you're on the mailing list for the future webinars, again, just email info@getblueprint.io. And we're looking forward to seeing our next set of webinars. They're always free and hopefully they're informative. Have a great day. Thank you.